Welcome to the Tax Talks. Extremely happy to be back and to be able to brief you before the holiday season break, which may result in us being dispersed in the coming weeks. So we thought it could be useful to take stock of where we are today in a pretty vibrant environment. If you want to join the discussion, you have the Twitter hashtag, you have the email address, so do not hesitate to post questions. We'll save around 15 minutes at the end of the tax talks, which will last 1 hour as usual, to respond to your question. Quick introduction. I would start with the fact that we are still in a vibrant environment. I mean, we cannot ignore the US tax reform, which seems to be happening, which is pretty good news, even though there are a number of questions, given that this was rushed and impressively fast. Somebody the other day told me, well, you thought BEPS was fast, look at the US tax reform. So everybody will be watching what are the consequences, the spillovers, the new rules, but moving territorial, reducing the rate, I think everybody will agree that it is a very positive move. The environment is vibrant also because of many other topics. The discussions on the digital economy, and in our area also, I have to mention the Paradise Papers, which will launch the debate on mandatory disclosure. The G7, the EU are working on that, on transparency and the work on exchange of information with the start of automatic exchange of information. A few months ago, we mentioned that during the previous webcast. The EU list created some activity in terms of commenting, but also some other tax topics which are not necessarily the bread and butter of tax lawyers, but more for tax economists, work on inclusive growth, work on tax and environment. I mean, there are many things here, and that's why we will dedicate part of this webcast to tax statistics, revenue statistics, which are the basis for tax policy makers to develop their tax policies. G20 update, I think, could be of interest to you. We had a couple of weeks ago in an extremely nice place called Bariloche, which is in Patagonia, Argentina, the first meeting of the deputy finance ministers. By the way, today is the meeting of the Sherpas of the G20 in the same city of Bariloche. To discuss the agenda of the Argentinian presidency. And we'll come back to the topics in a second. Let's look at the calendar first. March 2018, we'll have the finance ministers meeting. It's mid-March, 17-18, I think. Then we'll have the finance ministers meeting also of the G20 back-to-back to the spring meetings of the IMF. This is mid-April. There will be another finance ministers in July and the leaders summit in November, I think, in probably Buenos Aires. The topics: tax remains high on the agenda. That's the outcome of the discussion among the deputies. And you would not be surprised to hear that tax and the digital economy, or the way we like phrasing it, the tax challenges of the digitalization of the economy is the topic, the flavor of the day. Everybody's talking about that. Everybody wants to discuss this, and there will be a report for the April finance ministers meeting, but it's more than likely that we'll have a discussion of this as early as March with the first finance ministers meeting during the G20 presidency by Argentina. BEPS implementation, the MLI, the implementation of harmful tax, dismantling harmful tax practices, the other minimum standards, CBCR, is going to give ground to regular reporting to the G20, transparency, including an update on the criteria to list countries which would not satisfy the criteria on transparency. It's rather a non-list today, which can be considered as a failure. We see it the other way. It's a success to the extent that everybody's moving. Now, everybody has moved to the criteria which were, as you may remember, commitment to automatic exchange of information on the one hand, signing the Multilateral Convention on the other hand, and finally being at least largely compliant for the Global Forum. We may need to update the criteria. That's a mandate we received from the G20, because now we're moving to effective implementation of automatic exchange of information, so we don't have to judge the commitment any longer, but the implementation. Maybe some work on beneficial ownership, which is ongoing, and finally, a very important update on tax certainty. That's the agenda of the G20, primarily, as you see, tax and digital. David will go back to this later on. Recent developments at the OECD, in a nutshell, you can see that the work on harmful tax practices has progressed quite significantly. We have reviewed more than 160 regimes which against the criteria on harmful tax practices. We identify 99 regimes where action is required. There are 80 of them where the process of amendment is on its way. And in particular, we reviewed 52 IP regimes against the revised nexus approach. 27 of them are in the process of being amended. Only 2 were found harmful. France and Italy. Italy only on the transition aspect, France on the regime. I understand that France took a commitment in the European Union a few weeks ago to fix the regime by the end of 2018, which means that all the regimes would have been then fixed. We also published recently a report that you can see on the slide on the review of automatic exchange of tax rulings, identifying more than 10,000 rulings which will have to be exchanged, and already 2/3 of them have been exchanged. We have updated our website to provide an interactive map with key indicators and outcomes of the OECD tax work. You see a sample disclosed on the screen. It's both on exchange of information on request. You have Brazil on this example, automatic exchange of information, committed, not committed, having started or not, but also the BEPS work. A couple of more examples with Botswana being disclosed there. Close to 150 countries are on this new dataviz. I think for practitioners, this is a very useful tool if you want to know where a jurisdiction stands. Last word, no, not last word, by the way. Another word on country-by-country reporting. We have some news there, and pretty good news. First, we will be issuing next week a release with more than 1,300 exchange relationships expected to be announced. This is for the exchange of CBCR, and we will also update on the status of the implementation of CBCR. It's happening now, as all tax practitioners we know. We have spent a lot of effort, and I would like to thank the team for that, to avoid and minimize unnecessary local filing. There were a number of gaps in legislations here and there in the network of agreements, which may have resulted in some countries enacting local filing, not having the agreement yet in place, for instance, with the US, which is one of the largest countries with which the problem arose. And we have been able to minimize that. There will be no local filing in 2016 in Turkey and Israel. You may have seen that we published yesterday or 2 days ago information on joint statement between the US and France, so there will be no local filing in France for US companies, and the deadline for local filing in India has been extended until April, which may be a way to fix this. So a lot of work behind the scene that you don't see, but the outcome you can see, and I hope is satisfactory for practitioners. So the US recently signed bilateral agreements with France, Jersey, more under negotiation. We have 67 signatories of the CBCR, MCAA, sorry for the acronyms, for the country-by-country reporting Multilateral Competent Authority Agreement, with Bulgaria and Monaco joining soon. So a set of information that you can find on the through the link which is provided on the slide, and that you will find on our website. things are moving, and you can see that the cost of compliance, we try to keep it ring-fence, limited through all these efforts. Linked to that, the work we're doing on tax certainty, a good example of that work, beyond the report that we will be providing to the G20, emphasizing all the other initiatives and the work of the Forum on Tax Administration, the ICAP, Insurance Compliance Assurance Program, International Compliance Assurance Program, which is a voluntary program. You can see that a number of countries have joined: Australia, Canada, Italy, Japan, the Netherlands, Spain, the UK, and US. France is an observer there. Japan has joined recently. There will be a launch of the first initiatives based on a voluntary basis, again, in January in Washington, with a focus on transfer pricing, on P risk. It's an 18-month pilot program. And finally, willing countries, learning countries will join, and learning outcomes will be incorporated into possible wider rollout in the future, hoping that we'll have more administration. This can be a game changer for the audit and the risk assessment of multinational companies through a multilateral approach, which would minimize the risk, minimize the cost of compliance, and for tax administration, minimize the cost of operating. More to come, and the launch in January through a conference in Washington will probably be of high interest to you all. I'll stop here by just describing what will be on the menu of these tax talks. Revenue statistics, as I indicated to you, just to give you a sense of what we're doing and how this is useful for tax policymakers, but also for tax practitioners. We will be developing some information on the tax challenges of the digitalised economy, which is another way to phrase it. And David Bradbury will update you on where we are. A report is being prepared for the April Finance Ministers meeting. The negotiation is going on, so we'll not disclose the content of the negotiation, but we can give you some sense of directions. Tax treaties and the BEPS Multilateral Instrument. Sophie will give us an update on that. Mutual agreement procedures. We have a special guest for the first time. Sandra is joining us. Sandra is in charge of the MAP forum, of the peer reviews. She's taking 1 hour of her schedule because the MAP forum is meeting right now to adopt a new series of reports, which will be revealed or disclosed today or very soon. So she will give you a sense of what's going on there. And finally, John Peterson will give us some update on something which is going on in the G7 and at the OECD and at the European Union, which are mandatory disclosure rules, which got some political traction, particularly in the aftermath of the Paradise Papers. But first of all, let me turn to Michelle, who's in charge of revenue statistics and all statistical work at the OECD, so that she can brief you on what we do on revenue statistics. Michelle.
Thank you. The Revenue Statistics series provides detailed comparative information on tax revenues according to a common classification which is used across all countries in the series. Revenue statistics is a tool that is used by tax policymakers and tax administrators to make comparisons both across countries and across time. It presents two main indicators. The first is an indicator of the levels of tax in an economy, which is the tax to GDP ratio, and the second is the tax structure in an economy, which is the share of a tax in the total tax revenues received by the government. The series currently covers 78 countries across 4 annual publications and an underlying database. The oldest publication is the OECD publication, which has data back to 1965, and we also have 3 more recent regional publications for Africa, Asia, the Pacific, Latin America, and the Caribbean. The regional publications are produced by the Centre for Tax Policy and Administration in cooperation with the OECD Development Centre and a number of regional partners with the financial support of the EU. The publication which was released most recently in the series is the OECD Revenue Statistics publication, which came out on the 23rd of November this year. This publication shows that the average OECD tax to GDP ratio in 2016 was 34.3%, which is an which is an increase of 0.3 percentage points since 2015 and is also the highest level on record. This compares to averages in 2015 for Africa of 19.1% on average and the Latin American and Caribbean region of 22.2%. At the same time, the share of personal income taxes in total tax revenue has increased to just under a quarter of total tax revenues at 24.4% in 2015, compared to 2014 where it was 24.1%. At the same time, social security contributions and goods and services taxes have declined as a share of total tax revenues, while corporate income tax revenues have stayed relatively flat. Although the OECD average is 34.3% of GDP, there's a wide range of tax to GDP ratios in OECD countries, ranging from Mexico with a tax to GDP ratio of just over 17% to France and Belgium, which both have tax to GDP ratios of over 45%. Nonetheless, 2/3 of OECD countries have tax to GDP ratios within 5 percentage points of the OECD average. There's also a wide variation in tax structure across OECD countries, and this graph groups countries according to where their predominant share of revenues is derived. The first group of countries shows countries who get the largest share of their revenue from income taxes, both personal income taxes, which are shown in light blue, and corporate income taxes, which are shown in dark blue. The second group of countries shows countries which receive the largest proportion of their revenues from social security contributions, and the third group of countries shows countries which receive the largest proportion from taxes on goods and services, which includes VAT as well as excise taxes and sales taxes. Tax structures across the OECD also change across time in response to changes in tax policy, tax administration, and economic conditions. And a period of particular change was observed in the financial crisis in 2007 and 2008. This graph shows the change in 4 major tax types during and shortly after the financial crisis, and in each year it shows their position relative to their pre-crisis position in 2007. There are 3 primary trends observed in this graph. The first is for the top two tax types, for social security contributions and for goods and services taxes, which both increased during and shortly after the crisis before decreasing steadily since 2010. The second trend is seen for personal income taxes, which dropped shortly after the crisis but have been increasing steadily since 2010 and have now exceeded their pre-crisis position. And the third trend is seen for corporate income tax, which dropped sharply during the crisis and has since remained relatively flat. I'll now hand over to David to talk about the digital economy.
Thanks very much, Michelle, and it's great to be with you all. Good morning, good afternoon, good evening, wherever you are in the world. It's great to have the opportunity to speak to you about the work that the OECD is doing on the tax challenges of digitalisation. As Pascal mentioned earlier, this is an area where we're very active. There's a great deal of public interest in the work that we're undertaking, and we are very much working towards, at this stage, one key deadline, and you'll see that in the red part of the slide there, the April 2018 delivery of the Interim Report to the G20 finance ministers. On this slide, I provide a short update on the process that we've gone throughout the year in terms of the work of the task force on the digital economy. The task force was originally established as part of the BEPS project. The decision was then taken to prolong its work, and at the start of this year, we formalised the new mandate of the task force. We've met on 2 separate occasions in the full task force setting. The Bureau has been meeting on a very regular basis. And what we've seen throughout the year has been a very big focus on public consultation. You'll see there the reference to the request for input that we issued in September, and then the public consultation meeting that we held on the 1st of November. And that was a public consultation held at the University of California, Berkeley. Now, the request for input was very much targeted towards honing in on some of the key questions that had been raised in the context of the Action 1 work in the BEPS project, so that we could use the responses received from various respondents to then form the basis of the ongoing work that we need to carry out. As part of the public consultation process, we received 53 written submissions, and you can see from the pie chart on this slide the breakdown in terms of where those submissions came from. Very strong representation from the private sector, from the business community. 46% of the submissions were received from there, but also a range of submissions were received from professional groups, academics and university and researchers, as well as NGOs and civil society. So very good response, some very useful contributions were received in the context of that work, and we take the opportunity to thank those that made those written contributions. As I mentioned earlier, we had the public consultation meeting in Berkeley. It was an excellent event, very well attended. Over 100 people were there. We had a number of structured sessions that focused in on the key areas that I'll mention in just a moment, which very much relate to the areas of focus that we will concentrate on in the context of the interim report. And I should mention that we have a webcast of the event, more than 2,500 views. I understand only about 2 of those relate to my mother's viewing patterns, but if you haven't seen the webcast, I encourage you to have a look. Perhaps over the holiday season you might have a lazy 8 hours where you might be able to have a look at that. You won't regret it. In terms of the public consultation, a number of key messages came out of the engagement that we had and the various responses that were received. I think it's important to recognise the first issue that was raised was the question of problem definition. And a number of respondents raised very clearly this question of saying, well, it's important for the OECD in its work to be clear about what are the underlying issues that you are focusing in on. And in particular, people really honed in on this question of the BEPS issues versus the broader tax challenges. And that was an issue that was raised and presented quite clearly in the Action 1 report through the BEPS project, and it continues to be an important distinction that helps guide the way in which we assess these issues. A second really significant point that came through was that almost universally, those that made submissions or interventions at the public consultation said that it's really important that the OECD undertakes some serious empirical work on the business models that we see emerging in the digitalised economy. And in that context, it's worth noting that a key focus of where people said we should be concentrating our efforts is on value creation, and you'll see in a moment that that is indeed what we have been doing. In terms of BEPS implementation, a couple of really significant points were made there. Very strong responses from respondents on this question of VAT progress, VAT, the implementation of VAT. People acknowledge that VAT rules that are being implemented are raising real revenue, and at the same time, they are also showing countries how to effectively tax cross-border digital supplies, and that has been an important part of the Action 1 work. Another area where issues were raised were in the context of the potential for conflicts around the way in which VAT is implemented. Even though there was strong support for the VAT work that has occurred, a number of people making submissions said it's really important that we implement those measures in a consistent fashion. And since that time, we have released further guidance to help countries as they seek to implement the guidelines. Another important point coming out of the discussions on BEPS implementation was around some real evidence that was provided by some of the professional advisors and some of the business representatives around the way in which businesses have restructured or have responded to the BEPS measures. And that was quite interesting, I think, for everyone involved in that discussion. And we've seen further evidence of that just this week from Facebook, for example, who have now announced that they will be moving to a local cell model in terms of the way in which they structure their activities across the globe. So I think as we start to see the evidence come in, there is a growing sense that as companies reflect upon the impact of BEPS, they are responding. Now, the two final areas of focus in the discussions related to long-term solutions and what I might describe as potential interim measures. In terms of long-term solutions, it was clear that the overwhelming majority of people that made a submission suggested that long-term solutions, understandably, should be preferred over any short-term or interim measures. And in that vein, people also made the point to reinforce what had been said in the Action 1 report, that it's important to avoid ring fencing of the digital economy, which is very difficult to do because of the fact that the entire economy is becoming increasingly digitalised. In terms of interim measures, strong concerns were expressed about short-term or interim measures, and in particular around the potential for distortions and double taxation. Just quickly, what can you expect to see in the interim report? Without giving too much away, as Pascal said, discussions continue to occur. There will be a focus on business models, as was suggested by those responding to the public consultation. We will focus on tax policy developments, looking at both BEPS implementation but also measures that have been introduced by individual countries. In terms of long-term solutions, we will have a chapter that will aim to establish a clear sense of direction for advancing action on long-term solutions. On interim measures, importantly, as we've previously indicated, the report will include some reference to what measures might look like if they were to be implemented to ensure that they minimise any harm. I think an assessment of the pros and cons of such measures will acknowledge that there are considerable limitations, and if countries are inclined to act, then it's important that they take into account some of the analysis that will be provided. There will be a chapter on tax administration, which will also be quite useful, and we will conclude with a focus on the next steps, and the report will set out a concrete roadmap for future work. And just finally, in terms of the next steps, the Inclusive Framework meeting, which will occur in January, will then be followed by a meeting of the task force in March, and as I indicated earlier, the objective is to then deliver the report, the interim report, to the G20 finance ministers at their meeting in April. Now I'll hand over to Sophie.
Thank you, David, for this very interesting. Thank you, David, for this very interesting topic, which leads very nicely to the topic of the trending tax treaty topic in the area of tax treaties. The first one is, what are the tax covered by tax treaties? It's a question that arises in the context of the enactment or the proposal of different domestic tax measures to deal with what David has discussed, the digitalization of the economy. And when you look at those new taxes, you question how they interact with tax treaties. And then the first question is, well, what is the scope of tax treaties and what are the taxes covered by them? And when you look at, for example, the Article 2, sometimes the definition is broader than what one may expect. Of course, tax covered, but also hybrid form of taxation are intended to be covered because the scope is very broad. The next topic is also very tied with the digital economy, because it raised a question on whether or not the threshold to tax business income in tax treaty have kept up with the way the economy is moving, the technology, and the new business model. Now, there's other trending tax treaty topics, one of them being the tax certainty that Sandra will talk more in more details later. But in the world of tax treaties, the MLI will bring into force, will change tax treaties and include a principal purpose test. Well, that test is a subjective one, and a lot of question about tax certainty in this area. And we are looking at how to enhance tax certainty in the application and interpretation of the principal purpose test. Another subject in tax certainty, it's involved trying to identify the most common areas of tax dispute and see whether we could provide greater clarity and produce certainty. MAP arbitration is also a very important tool to get more certainty. Another trending topic is Action 6 peer review, which will start next year. and with an anticipated report in 2019. Now, countries that have signed the MLI and are implementing it are very well positioned. Countries that have not will need to update their tax treaties and update them in order to include the minimum standard on treaty abuse that is covered by Action 6. And of course, there's the very anticipated entry into force of the MLI, and I'll talk about it in greater details later. The 2017 update of the Model Tax Convention was adopted by the OECD Council, and I'm very happy to tell you that the PDF version of the condensed model will be released next week. Now, you'll have to wait a little bit longer to have in your hands the very important Blue Book, but it should be available early mid-January. The update will include all of the treaty-related BEPS measures, both in the model, but also very useful commentary to help you interpret and help the application of those new BEPS measures. Now, the entry into force of the MLI is coming very soon. As I said in a previous tax talk, we need the ratification of 5 signatories before the MLI enter into force. Now, we have first 2 countries that have ratified the MLI, and we anticipate very soon to have other. For example, Poland has announced that they're very close to ratify, and we're looking forward to receive more ratification. Once we have 5 ratification, the MLI is in force, and after that, the countries will have their own date for the MLI entry into force. We expect to have a lot more ratification very soon, because countries are working very hard right now to have this, to deposit their instrument of ratification. Now, once everybody has ratified, what will be the matching result? It's too early to tell you exactly, but we have already some data that are very interesting. We can see right now that most of the tax treaties covered will be impacted by the MLI. On the new preamble to protect the tax treaty against abuse and the principal purpose test, all of the tax treaties that are covered in the MLI will be updated and include that. Some of them will have a simplified limitation on benefit as well. And on the permanent establishment, several tax treaties will be also updated and include those new provision on tax treaties, and the 2017 model is supplementing in terms of commentary to apply those new provisions. The mutual agreement procedure has also been updated. Those treaties have been updated and or will be updated as soon as they're ratified. And finally, on arbitration, although the number is 160 treaties that will be updated to include a new arbitration provision, it is our hope that more countries will implement the mandatory arbitration as they hear about the good experience of others with arbitration. So on that, I will pass on the clicker to Sandra.
Thank you. Yes, thank you, Sophie. So perhaps I can start with giving you a little bit of where we are in terms of the MAP peer reviews. We already finalized batch 1 and batch 2 countries. Both of them have been approved and been published, and when I say they have been published, batch 2 has been published today, so just on time for the tax talks. Very happy with that. Batch 3, and that's also very recent news, concerns 8 jurisdictions. We have discussed these reports in the FTA MAP Forum this week, and we have finalized these reports, and so the MAP Forum approved these reports. They will now go to the inclusive framework for final improvement, and then they can be published as well somewhere in the beginning of next year. Batch 4, and that's perhaps important for you, will be launched at the end of this year. There is already taxpayer input required, and if you want to provide input, and please do so, you can do this by the 22nd of December. Now, as I told you that batch 2 has been published today, perhaps I can share with you some findings that we had in this second batch, and I will structure it with the 4 key areas of dispute resolution, and the first is prevention of disputes. We see that France and Italy do not provide for rollback. All other countries in the second batch do provide for rollback in cases of APAs. If I go then to access to MAP and availability of MAP, we see that there is an issue of not notifying the other competent authority in case a MAP case can only be introduced in the country of residence. So some countries, all countries that do not have an either in their tax treaty, that will be changed via the MLI for most of them, will have to notify the other competent authority. Some do not have this process in place yet and will, like France and Luxembourg, but they have been working on it since then, so they will have it or they already have it now. There is one big problem that we identified, and that is that there was no access to MAP in cases of an audit settlement in case of Italy, because they thought they could not go for arbitration, and then they deny access to MAP in cases where the arbitration convention was applied. So this is one that we did identify. For Germany, there were also some situations where there can be like an agreement between the taxpayer and the tax administration, but in the case of Germany, access to MAP is provided in these situations. If I then go to resolution of MAP cases, the 24 months, the average of 24 months is very challenging for a lot of administrations, for a lot of competent authorities. Many of them do not attain this 24-month average, and it seems to be a lot more difficult for transfer pricing cases than for other cases. Now, on the other part, what we see a lot is that many competent authorities have had additional resources, so that they are doing their best to decrease their MAP inventory, and that they will treat their cases more quickly because they will be able to send position papers sooner, have more face-to-face meetings, and try to resolve MAP cases in a shorter period of time. You can see it on the slide. Many jurisdictions in the second batch did get additional resources or are also foreseen to have extra additional resources in the near future. As far as implementation of MAP agreements, not much problems occur. We have not been informed of any problems. In fact, there are some theoretical possibilities where there is a problem. For example, in France, when it is a very old MAP case, it is possible that it will be difficult to implement or to reimburse if they do not find any information anymore on that case. But France is doing their very best to implement all these cases anyway, and up till now, all cases have been implemented. Now, as far as the treaty analysis, we always come to the conclusion that many treaties need to be changed. Luckily, many of them will be changed via the MLI, and I'm very happy to see the 1,100 in the slide of Sophie. Now, there was one jurisdiction that did not need to change a lot of treaties, and that's Liechtenstein, but that's perhaps because they only have a very small number of treaties, and they have been all signed recently, so they are up to date and they don't need to be changed or modified. And then lastly, MAP guidance. Well, most of them have MAP guidance, have good MAP guidance. Sometimes we need to give a little bit more information in the MAP guidance, but in general, the MAP guidance is quite good. Then I also want to share a little bit on the MAP statistics with you. They have been published on the website at the end of last month. I added the web page so that you can go and have a look. Just in general, you see that we start with a inventory of 8,000 cases. Now that is more than the end inventory of 2015 statistics, but that is also because now we have much more jurisdictions that do provide statistics. So now we are at more than 65 jurisdictions that have provided statistics. You can see the number of cases started, about 1,500, cases closed, a little bit more cases closed, and then the end inventory. Now there is one specific thing that I need to tell you. There is this difference between cases before 1 January 2016 and then the cases after 1 January 2016, and that's the date where countries committed to the minimum standard. We have different information for the one cases and the other, and where there was a bigger possibility of double counting for the green cases, there is less possibility of double counting for the, if I can call them, purple cases. So the more we move on during the next years, the more the statistics will give a very correct view of what's going on. On average, cases have been resolved within 24 months, but you have to take this into perspective. Some countries with many cases were within the 24 months, and they, of course, help to get the average within the 24 months. But it is a good sign that, on average, cases are being resolved within 24 months. Some information on the top 10, I would say, of number of cases in inventory at the end of 2016, and some of them are quite high. But in the statistics, if you go to the website, you will find specific information on a country. Information on, are there many other cases, are there many transfer pricing cases, how big is the inventory, how many cases come in every year. So that will put these numbers for some jurisdictions into a certain perspective. Because if you have like 700 cases in your inventory, but you receive and solve more than 350 per year, that gives a completely different view than having many in your inventory, but only receiving less and solving less every year. And of course, there is a difference between other cases and transfer pricing cases as well. So you can get all the country-specific information on the website. And then a final piece of information, now you also get information on the outcome of MAP cases. That's very important. You can now, and that's part of the transparency of the new statistics reporting framework, where we also give you an ID, and you can get that same information per country on the outcomes of the cases closed. So you can see here that about 60% of the cases are being solved with eliminating the double taxation or the taxation not in accordance with the treaty. About 20% are already solved at the unilateral phase. Another 4% are being resolved via domestic remedy. So we come to more than 80% of the cases that are closed with a full resolution of the problem for the taxpayer. So if you want more information on that or on a country specific, you can find all that information on the webpage. And I think with that, I can give the floor to John.
Thanks, Sandra. Thanks, Sandra. It's amazing what you can find on the internet these days. So from me, a little bit about mandatory disclosure, just to finish off our presentation here. We say it often, but it's true, and it's something we're very proud of, that significant progress has been made in EOI and exchange of information over the last decade. We now have, 115 jurisdictions that have ratified the MAC, and 50 jurisdictions this year started exchanging financial account information, and that will be followed up by another 50 next year. So significant progress there, but there are challenges that still remain. Most notably, as Pascal said, in relation to the public leaks such as the Panama and the Paradise Papers, they create an environment of concern around the offshore tax planning industry, certainly evidence that industry is alive and well. And while that data is historical in the sense that it predates the introduction of the CRS, there is significant evidence in the Panama Papers in particular of structures that were introduced to defeat reporting obligations. In that case, it was the European Savings Directive, but we are aware that this is an active area of tax planning. And that's backed up by evidence that we collect through the compliance activities of tax administrations, as well as the OECD's own CRS disclosure facility, which is a facility, an online facility that you can access online and provide us with information of these types of schemes. And what are these schemes? Well, there are a variety of structures. Some of them are simply offshore structures that are put in place to hide the underlying identity of the beneficial owners. But there is really no limits here to the ingenuity of taxpayers' imaginations. In these cases, we have seen residence by investment schemes where taxpayers obtain certificates of residence from jurisdictions that they then use to open bank accounts. We have seen people applying and opening pension schemes in countries where they do not work and do not live in order to avoid reporting under the CRS. So we're aware of these challenges going on. They're happening now, and because of that, the G7 in May of this year called upon the OECD to look into this. They said, asked us to look at ways of addressing both CRS avoidance arrangements and offshore structures, and particularly asked us to look at the possibility of the design of model mandatory disclosure rules that were inspired by the approach that was taken in the Action 12, the BEPS report, which was focused on tax avoidance, but to look at that approach and see whether it could be adapted to the CRS and offshore structure framework. So that's what we did. We're working on a number of different possibilities, some in the tax policy space, some improvements to tax administration practices and cooperation, but also looking at what the design of those model mandatory disclosure rules would look like. And that is the paper that we have put out at the beginning of this week. And there are really 5 questions that that paper addresses, which are really the standard 5 questions that you ask when you look at any type of mandatory disclosure regime. The first obvious question is, well, what schemes are we targeting here for disclosure? Who are we going to require the disclosure from? Who are we going to provide these disclosures? When are we going to require those disclosures to be made? And typically the answer to that is as soon as is practically possible. What kinds of information is going to require to be disclosed as part of that disclosure obligation? And then particularly importantly in the context of these international obligations, where is that disclosure required? And what jurisdiction is disclosure going to be required? So the key focus here, I guess, is on what schemes are we covering, what is the scope of this measure, and the answer is CRS avoidance arrangements and offshore structures. CRS avoidance arrangements then are arrangements that are designed or marketed or that have the effect of circumventing the CRS, which includes undermining the disclosure obligations and the reporting obligations imposed by financial institutions under the CRS. In addition to that, there is a separate category on offshore structures. And what that category is designed to do is pick up particular features of offshore structures that we know impede the ability of tax administrations and financial institutions, if they're doing their due diligence as part of a CRS process, that impede their ability to identify the underlying owners and controlling persons of those structures. So it picks up things like informal methods of control, undisclosed nominee relationships, and the like. And then in terms of the remaining factors there, who are these rules targeting? Well, essentially those who are promoting the arrangement, but also those who are providing relevant services in respect of that arrangement or offshore structure, if in those circumstances they ought to know that that's what they're dealing with, that they have a CRS avoidance arrangement or offshore structure in play. These disclosures are required essentially as soon as the scheme is made available to a taxpayer, and then whenever relevant services are provided in respect of that scheme. So there's an ongoing disclosure obligation in relation to that scheme, and the information you disclose is the nature of the scheme itself, as well as the underlying users of the scheme and the jurisdictions in where they're tax resident. And the disclosure is required in those jurisdictions where those intermediaries, those promoters and relevant service providers are based for have a taxable presence. Now, these obligations are backed up by obligations that fall on the user of the scheme to disclose in those circumstances where the intermediary is not required or not able to disclose the scheme, perhaps because there is a claim of privilege that attaches to that scheme. And also with an exchange of relevant information between tax administrations. So if a scheme is disclosed in one jurisdiction and it relates to a taxpayer in another, that information can be disclosed under the MAC between those 115 jurisdictions that we mentioned previously. In terms of stakeholder input, we are keen for your input on this measure and would like to have your feedback. If you'd like to comment, you should do so by the 15th of January in writing. There is the email address that you can send the comments to, and you should be aware that all comments that we make on that consultation draft will be made publicly available. All right, I'm going to hand back to Pascal.
Thank you, John. And we'll move to the questions. We have a bit, around 10 minutes to respond to your questions. I hope this was useful information brought to you. You can see that we're still very busy. Things are happening. It's quite exciting. It's difficult at a time where the international framework is a bit difficult. So we hope that tax will remain high on the preoccupation of states and will remain a good way to progress multilateralism, to keep countries together through the very technical work which we are doing, which sometimes has some political dimension. I think David shared as much as he could on the digital economy, but here countries are working together, and that's pretty good news. And there are many things that you don't necessarily see, but I can assure you that in the background, behind the curtain, countries are working together, governments engaged, not only at the political level, but at the technical level. There is extremely good cooperation within the inclusive framework, within the Global Forum. I didn't mention that the Global Forum had a meeting in Cameroon. Interesting, in Africa. We have many more African countries joining the Global Forum, developing countries. The Global Forum was pretty great success with a declaration of Yaoundé from African countries on illicit financial flows and the need for political attention there. We have this task force meeting on the digital economy earlier this week, and there is a good sense of moving the ball forward, providing good analytics to provide for sound tax policies, recognizing that there is pressure here and there to do unilateral measures, short-term measures or interim measures, the way you want to call them, and that after all, even though these measures may not be good, and I think the report will explain how they could be damaging if countries are to happen, if these measures are to happen, may be good to put a frame on what countries shouldn't do. So we are working on that. And on the long-term solutions, we'll see the US tax reform and the consequences that the US government and administration will take away from that reform in the international debate may also be a useful avenue for further cooperation in spite of questions sparkling here and there. I didn't mention at the beginning that the inclusive framework has increased recently by 2 members. We are now at 110 members. I think it's 148 or 9 in the Global Forum. And also some further work towards full transparency. The Bahamas was here a couple of hours ago to sign both the Multilateral Convention on Mutual Assistance, but also the Multilateral Competent Authority Agreement to automatic exchange of information. I understand that Panama announced yesterday, on Thursday, that they are also going to sign the Multilateral Competent Authority Agreement, which means that almost all the countries have moved there except from Brunei, maybe Bahrain, a couple of others. Hong Kong and Macau will soon be there too. So you can see that the different bits and pieces of international cooperation are getting together, and I think this is good news. Thanks a lot for all the tweets which have circulated. Apologies for not having welcomed you with a good morning, good afternoon, good evening. There are a number of tweets about that, so I will conclude with that. But before concluding, some responses to the questions which have been asked. The first question is, how many rulings? We say that 10,000 rulings by the end of 16 were to be exchanged, but 10,000 out of how many rulings? Well, I think the question should be how many international rulings which are in the scope of our exercise, because we think that the scope is broad enough to capture all the relevant rulings. We're not interested in a purely domestic ruling issued by one country to a company which has no international spillovers, because there are probably, thousands and thousands of rulings. So we do think that out of the relevant rulings, we cover them all. We'll follow up on that question to make sure that the team which is in charge agrees, but that's the philosophy. So the philosophy was not to say it's 10,000 out of a broader basket, but rather to identify all the relevant rulings. A question for John, and we have 3 minutes left, so you have 30 seconds to 1 minute. John, when offshore structures are disclosed to tax authorities, what additional certainty do taxpayers get as a result of these disclosures?
So I think there is a general certainty benefit that comes from these disclosure rules by virtue of the fact that we have a standard set of rules now in place that require disclosure of particular identified structures. So I think it sets very much a framework for understanding what kinds of structures are perceived by tax administrations to raise risks. However, in respect of the disclosure itself, the answer is there is no additional certainty that's granted through a mandatory disclosure regime in relation to a disclosed scheme. It's always been very clear in the mandatory disclosure context that disclosure is just an information disclosure, and the fact that the tax administration responds or does not respond to your scheme does not give you any additional comfort one way or the other as to the acceptability of your scheme.
Thank you, John. I will turn to Sophie with a question on the MLI. Do you expect that most of the signatories to the MLI will have ratified by the end of 2018?
Yes, we do expect that most of them, and that's what we hear from countries, is that they're really working hard towards ratifying the multilateral in 2018. And that's important that they do so, especially in the context of the Action 6 in anti-abuse, peer review, because their commitment towards the MLI and ratifying one of the main features of the MLI, which is treaty abuse, so we'll be monitoring this in the peer review, so that's important that they do so.
Thank you. Optimism here on that front. Question for Sandra. Have you already encountered changes to MAP because of the minimum standard?
Thank you. Yeah, interesting question. We already see, while during the peer review, and I already spoke about it, a lot of competent authorities either reorganizing so that they would better be equipped to deal with MAP cases, but also getting extra staff. What we also see, and that's a very important message to give, I think, is that there will be a lot more access to MAP. And to give a specific example, India is now going to give access to MAP in transfer pricing cases for all treaties that do not have an Article 9, Paragraph 2. So there will be a lot more MAP cases, not because there will be more audits, but just because they will be giving access to MAP in all these cases. We see a lot of guidance that has been improved, or countries that are writing guidance so that taxpayers will know what they can do. So these are some of the examples, and perhaps a very important one as well, and that's one that I get from competent authorities when they speak to me, that is that they say, we already see a change because we are getting letters, we are getting cases from other competent authorities we never heard of before. So I think that's also a very good message.
Thank you, Sandra. I would just like to add a word there, because there are some saying that it's never been that bleak a picture on mutual agreement procedure. And you can say it, but there seems to be some evidence that, yes, there is an increase of disputes, that's for sure. What is it attributable to? I think that globalization, the fact that you have more and more international business may be the primary reason, even though some tax uncertainty may have increased from BEPS or other recent developments. But let's look at the trends. But what is clear too is that there have never been that many cases solved, and the stock is decreasing. And what we can see, talking to tax commissioners, to ministers, and to others, is that it is having an impact. And that was the strategy. Instead of talking forever about new dispute resolution mechanisms, or we should do this or we should do that, we just made it a minimum standard, which means that it's now on the radar screen of the policy makers, of the ministers, of the leaders of the G20. And for sure, tax commissioners, which had other things to do than putting this as a priority, made this a priority. And this is a game changer. I think the chart which was on the slide is extremely telling. A very large chunk of the cases are solved with proper elimination of double taxation. Is it good enough? No. This is why we are working on that. We're coming to the end of this webcast. We would like to wish you happy holidays to you all. There were more than 500 of you watching live this webcast. I know that some of them keep it for making sure that they would spend good holidays with keeping in touch with tax. So for those of you who look at us, watch us later on, happy holidays too. And there are other things to do than tax, so turn your computer off and go out now. Thank you all. We will keep you updated probably in January or early February after the Committee on Fiscal Affairs and the Inclusive Framework meeting, which will be held in the last week of January. Obviously, a lot ahead of us. The US tax reform, if it passes next week and if it's signed by the president, will definitely be a big game changer. What we need to do is to keep countries together and see what the consequences are of this reform, of all the other reforms on many aspects, digital economy being one of them. You can see that 2018 will be extremely busy for you, for us, so I wish you a good rest by then. Thank you very much.